Hello and welcome to episode 457 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks Damien. We're back in the studio together.
Yeah, we are, and it's the first time for a few weeks that we've recorded the podcast on video. So you can go and watch this episode on YouTube if you wish. And I just want to mention YouTube actually, because even when we don't produce a video that you can watch, there is always a feed or an episode that's put onto YouTube where you can actually go and leave comments. So it's just the audio. We always do that. And obviously we do try to give you the video as well. So I want to mention it because last week, some of you went onto the audio version on the YouTube channel. If you go onto the YouTube channel and you actually look along the top, there's a tab that says podcast. If you click on that, you'll go to all the audio versions of the podcast, and you can then engage with that and you can leave comments, which is really useful because it means that I can start to respond to you guys. And there's a couple of comments from last week which was, wow, what a brilliant summary for teenagers, well done. That was from somebody called Jam99, and that was the piece where I talked about how, or what I discussed with my daughter, who showed an interest in investing. So it's the first real conversation about it. So go and listen to that. And also from Rubik's Busters was a fantastic podcast. Been tuning in for about 4 months and have already shaved my expenses by at least £500 per month and have got some investments going. Thank you so much. So that is fantastic to see. Do go and engage on the YouTube channel. It's really good for our YouTube channel because that's how the algorithms work. But also, it's the easiest way for us to communicate quickly so we can actually write responses. And those two people actually have been offered Money to the Masses mugs via that. So you could too enjoy a Money to the Masses mug. So I'm getting into sending out a whole bunch of them imminently. So if you've been promised one and you've not received it, don't worry, they will be coming out shortly.
Well, it's good to be back in the studio and nice to have you by my side. So let's get straight on to what's coming up on the show. We've got 3 pieces.
So on the show this week, I'm doing a piece on investing. I'm just going to talk about where markets might be heading. I'm going to look at 2 particular markets. One is the FTSE 100 and the other is the pound versus the US dollar. And I'm using that one because even if you're not into investing, you might be going on holiday. And so you might be thinking, what's going to happen to the pound versus the dollar if maybe you're going to America? The other thing I'm going to be talking about, I'm going to do a piece on changes or a change to a particular credit card's minimum payments. But it's quite important because there's a big impact for people who have that card. But also there are lessons for other people who have credit card debt. And Andy, finally, you're going to be doing a piece on
mobile phone providers. So we're going to be looking at some recent research from which they've looked at the 4 major providers and looked at the customer service and feedback and price and things like that. And actually there's been some surprising results in that the top 4 of the mobile phone providers didn't fare very well. And actually it's the lesser known providers that are actually becoming more and more popular. So we'll explain what that's about later.
So for those of you who may be in the market for a new mobile phone provider, then you'll want to listen to that because you'll find out the best and worst providers out there. And there's some interesting insights actually for people who are going to be looking in the future. Now, before we get on to the show itself, I did just want to mention that it was Earth Day this week. So I had another interesting conversation with my other daughter, my youngest, and she said to me, Dad, do you know what day it is? And this was, I can't remember, it was Tuesday or Wednesday. I said, I don't know. She started to run around the house turning lights off. And I said, is it Earth Day by any chance? Okay. And so I was right. She started to tell me about Earth Day. And I then showed her something on Money to the Masses, which she was really chuffed with. And actually, when she went to bed, she said, oh, well done, Dad, on that. And so Money to the Masses does obviously take the environment very seriously. And we do pay money to plant trees. So if you go onto our Instagram page, you can find a post on there which shows you what we're doing for the environment. And so far, I'm just reading it here, we have planted 1,862 trees and helped fund numerous projects, including generating renewable solar electricity in Egypt and distributing cleaner cook stoves in Kenya. You can find out more about how we do that by going to the post. We'll put a link in the notes. So not only do we give you information and hopefully you love the podcast and you'll support the podcast via our new page, don't forget, but we are also doing some really good things outside of the money world. And don't forget, support the podcast, moneytothemasses.com/podcast. There's lots of things on there where you can support the podcast, newsletters you can sign up to, cashback, deals, all sorts of things. Do go there, check it out. And I've seen that a lot of you already have, so make sure you go and bookmark that page because it does really help the podcast. So with that all said, I'm going to go straight on to the investment piece. Now, interestingly, I do a piece of research periodically for 80/20 investor members, which is our DIY investing service. And you can take out a free trial where you can see the full research piece. So what we do is I look at where markets might head next. And the way I do that is I look at technical analysis. So technical analysis, for those who don't know, is a method where you look at a chart. If you get your stock market app up on your phone, you will see, if you find the FTSE 100, for example, you'll find a squiggly line that goes back over time with the movements of that index. Now, you can change the time frames. You can put 1 day, a week, you can do a year, 2 years, all time. So do that now while you're listening to the podcast. And we're going to show on screen, actually, on the video version of this, a chart so you can look at it. And what you'll see is there's lots of ups and downs, but you'll notice that there are kind of patterns that do occur. And there is a type of analysis that exists out there called technical analysis. And what it does is it looks at the ups and downs and draws lines of support and resistance. And now they are almost uncanny in terms of the way the market behaves. So if you think about market behavior, so people might buy and sell, and we're talking about retail investors, so people like us, or professional investors, and you're also talking about algorithms and all sorts of things like that, that there will be certain levels and triggers where they may buy into a market when it hits to the price gets to a certain level, or they might start to sell if the market falls by a certain amount in a given period of time. So there's these levels that exist, and if you can get a ruler and you apply it to a chart and you can join up some key parts. So if you, let's say the market rallied and it hit a top and then it started to fall and then it got to a low and then it bounced again up to another high, if you joined those higher points or the series of low points, you can start to see trends. If you get a ruler, draw a straight line, and like I say, we're going to put an image in the show notes of this podcast so you can see one that I've made. And there is also going to be one on the video that we do for this podcast. And if you can join 2 lines or 2 dots with a ruler, then you can really get into technical analysis. Now, you can get really ingrained in it, all different types of patterns, but very simply, there's lines of support and resistance, and there's trend lines going up and down. And these are respected over time. They tend to be. Now, some are obviously stronger than others, and what you tend to get is, if you look at that chart, you'll notice that there will be the market, for example, might start to rally and it'll get to a certain level and it will turn lower, and then it might go back to that level and turn lower again, and you start to see that's a line of resistance. The market is trying to break above this historic level, but it can't quite do it, and that will be because of supply and demand. So actually, when it gets to that level, there are probably more people selling at that level, maybe taking a profit, than there are people wanting to buy it. So therefore, that causes the market to start to go lower as more people are selling out. And then it gets to a level where people are starting to buy in because they think it's actually interesting and they want to start getting into that market. So there's lots of reasons why the resistance and support lines might be respected. Now, of course, they do break through them, and when that does happen, then it can signify a change of direction or trend. So if there's a support line that's existed that the market tends to bounce back off of when you've had a sell-off, if it goes through that, then that can show you that the trend could be even lower. So if you look at these things, they tend to be in the market, it tends to be a bit of a memory around them. And now you can look at them and see, right, the market is struggling to break through the previous highs. And what is interesting, the one I'm showing you is the FTSE 100. So look at the image and you'll see that there was an all-time high that existed that the market was trying to break through and was struggling with. And this week, we've actually seen the FTSE 100 finally join a lot of other stock markets and set a new time high. We've seen it in most other stock markets out there, whether you want to be the S&P 500, the NASDAQ, whether it's the Indian stock market, the Nikkei 225 in Japan, the German DAX. The FTSE was the laggard, and the FTSE 100 has finally broken through it.
On that, when you say finally, how long have we sort of been waiting for this? Is it something that's been bubbling around in the background for a while?
So it's a good question, and it's February 2023 was when we saw the all-time high in the FTSE before this week, and that level was around the 8,012 level. And since that point, if you look at your charts, you can see the FTSE had sort of sold off a bit, bounced around, then it sat in a channel. And I've drawn on the chart some lines of support and resistance. You can just see a general trend in it. What they're good for is showing you what the market's doing without the focus on the ups and downs each day. And so the reason I wanted to bring it to the podcast is just to get people to realise that this kind of analysis exists. We've talked about it before, but also if you go to Yahoo Finance, they have just updated the site there and the charting. So if you go and look at the various different indices that exist and you look at it on Yahoo Finance, you can go in and click advanced charting, and you can go in and you can draw all these lines on the charts. And there are tools that help you and make it easier to do so, and it's free. And it is a fantastic tool. I've been using it for years. And go and have a play around and see if you can join or draw lines of support and resistance and see if there are patterns on these charts. Now, different people might draw them slightly differently, but what it does do is to give you an overall trend, and it doesn't predict exactly what's going to happen. What it's like is, to use an analogy, is a weather map. So if you see a weather forecast, the weather person might tell you that it might rain, and then you get to that point and you actually it's blazing sunshine, and it's not an accurate prediction or guarantee of what will happen. It's one of the possibilities, and it therefore shows you that based on recent trends, this is what's most likely to happen. Same with weather forecasting. It doesn't guarantee that you're going to have sunshine just because you had sunshine yesterday, but based on the weather patterns, you can probably have a very good probability of what might happen next. So markets at the moment have been at an interesting point where we've seen US stock markets start to turn over. We've seen the FTSE 100 start to hit new all-time highs. And so people are obviously thinking what's going to happen next. Now, I don't know, but technical analysis is quite useful to giving you the range of possibilities and maybe what is likely to happen. And the FTSE 100 has been rallying because one of the reasons the US dollar has been strengthening against the pound. So we've seen the pound go lower, which tends to be positive for the FTSE 100 because a lot of the companies in the FTSE 100 generate revenue overseas. So their earnings come from overseas, particularly in dollar terms. So when the pound falls, that gives it a nice currency boost when you convert it back, those dollar earnings back into British pounds. So when the pound falls against the dollar, it therefore gives the FTSE 100 a nice boost. So that's one of the reasons. And also the price of oil has been rallying, and there is quite a significant oil exposure in the FTSE 100 in terms of the companies that are within it. So if the price of oil goes up, their profits tend to go up, and therefore their share prices tend to. So that is one of the reasons why it's been going higher. But if you go and look at the charts and draw lines, you can see that the FTSE 100 was really stuck in a band between 7,730, so 7,730, and 7,257 for the best part of a year. And then what's happened in about March this year, we saw the FTSE 100 break out. And when you get a breakout from a channel, one of these trends, you then start to pay attention, because if it breaks out and then manages to close above that level and then continue that trend, then it means there could be a change in direction. And then what we've seen is an uptrend that's formed, and you can see on the chart, if you look, there's almost like a channel that as it's going up, it doesn't go up in a straight line, it goes up and zigzags on the way up. Then it's going up, it falls, tests the different levels on the way up, and this new uptrend has developed in the FTSE 100. So at the moment, it would look like the FTSE 100 has been trending higher, and there is a possibility that we can get further new highs in the FTSE 100, irrespective of what's going on in other stock markets. So technical analysis is quite interesting, because if you look at this, when the US stock market had been setting new all-time highs, the FTSE, if you looked at it and looked at the technical analysis, was struggling to break above 7,730 despite all the bullishness in other stock markets. And it wasn't until it broke above that level that we then could start thinking that we could start to see new all-time highs. And eventually we have broken above a new all-time high, so we are setting new ones. And eventually when the market starts to turn lower, that new all-time high, or the last one, will start to be coming a point that they've got to break again, if that makes sense, before you can then start to think, is this a continuation of the uptrend, or is the uptrend going to continue? So technical analysis, go and have a look at the charts. It is interesting. You'll see how simple it is. Yahoo Finance have a fantastic tool where you can go and draw lines of support and resistance. Now the tip, if you're trying to draw a line on these graphs, try and draw lines that go between 2 points, and preferably 3. So if you're doing, say you're drawing in the lows of a trend, then you want to get at least 2 or 3 on the line that you're drawing. Have a go. If it's an uptrend, you want to get like the peaks. You want to try and join the peaks. So you want to try and join 2 or 3 of those. And if you look at the charts that I've got, you can see that I have joined up normally at least 3 points to formulate a line, because you can't just draw a line around a single point, because that's not a line of resistance. That's just a point in the sand. You're actually needing 2 points to draw the line between. And if you see on the charts and the image that we've associated with this episode, how simple it really is. And if you can do that, then you can start to have a look. And really, it's not about betting on where the market's going to go. It's giving people an idea that, right, okay, global stock markets have been turning lower. What might the FTSE do? And then you can see that really, at the moment, the old all-time high of 8,012 is key. Because if we break below that, then you could see that possibly the market has actually formed something called a double top. I won't get into that in this particular episode. But then the line of 8,000 is quite key. So you can see that old levels of support, when you bounce off them and you go through old lines of resistance, they turn into support. And if you break below a support level, that becomes resistance, if that makes sense. So it's like rungs on a ladder. You've got to get up. And if you break down through them, then you're going to have to fight to get back above them again. So that's why lines of support and resistance are interesting, because if we go back below the 8,000 level, then that will become a line of resistance that it's got to build up basically momentum to get back through it. So it's an interesting concept. I've done a series of stock markets. I've done the US stock market and the Japanese stock market for 80/20 investors, and it's almost uncanny how accurate the predictions or the insights you can gain from these kind of charts. And more importantly, even if the trend is going up, if it's going up like it is now on the FTSE 100, you could see the levels that are important that it remains above if the trend is to continue. So that's something. So I want to just quickly go over to the pound, because those of you who are interested in what's going on with the pound obviously, as I mentioned, influences the FTSE 100. So what's going on with that? So if you look at your chart on your phone, so in your stock app or the one that's associated with the podcast or on the video, you can see that we had a downtrend in the pound versus the dollar into the lows of around October, November. Then the pound rallied into the new year, and then we got kind of stuck in the new year all the way until about March time, and then we broke down, and we broke down quite significantly, and we started to form another downtrend, so a new downtrend that's starting to take shape, and the market's been testing and trying to break out of that, but fading on the way, and you get this kind of channel that occurs. So we have the market turn low, and it's going through all these previous support levels that are now turning into resistance, that it's got to build momentum to get back up above. And so before it turned lower, we almost got to around about $1.28.5. So that's how many pounds, the exchange rate. We then started to break down. We tried to break back up again. You can see it on the chart. And then we've now got down to a low that was around about 123.5. So that level, again, was an old support level. We've bounced off it again. But what you can see, despite the recent rally heading back towards 125, it isn't until we start seeing the pound head fair bit higher, especially above 126, that you might be able to say that this downtrend might be negated and we might get back to the recent highs. So at the moment, we are still in a downtrend of the pound versus the dollar. So that will have an impact if you're going on holiday, but it also has an impact on things like what the FTSE 100 does, or on your overseas holdings. So if you've got American holdings in your portfolio, then anything that's obviously denominated in US dollars will get a nice currency boost when the pound falls, because your dollar assets, when they're converted back into pounds, when they're reported, then they're actually going up because of the currency boost. So that is something you'll start to see. And you may be wondering, why has the pound fallen against the US dollar? Well, it's actually down to something called divergence, and I'm talking about central banks. So in the UK, as you know, we've got the Bank of England, and in the US, they have the US Federal Reserve. So we take the Bank of England, they will raise and lower interest rates to try and control inflation. So with inflation proving sticky, then recently the bets on when the Bank of England could cut rates have slightly changed. So they aren't predicted to be able to cut rates as early as previously thought. It was assumed they'd be able to do it probably in about August, but now it's gone to about September, October as the first rate cut in the UK. But in the US, they were predicting that the US Federal Reserve would probably be able to cut rates much sooner because they had got inflation a bit more under control. We're talking about sort of going back to a few months ago. Things have changed a little bit. Inflation has proved a little bit stickier than people had thought in the US, whereas in the UK, inflation has continued to come down, but it was slightly ahead of where people had previously thought it would be in relation to maybe the US or other economies. So therefore, where they had previously thought the Bank of England would be one of the last people to cut interest rates compared to, say, the Federal Reserve or the European Central Bank, it then suddenly became that possibly the Bank of England would be cutting rates now, possibly as soon, maybe even sooner than the US Federal Reserve. And of course, that then started to impact currency exchange rates. So therefore, it meant that when rates are predicted to be lower in the future, that causes a currency to weaken. So the pound weakened against the dollar. And of course, they were unwinding bets that the Federal Reserve would be able to cut rates. So they were actually thinking that rates would be higher in America for a little bit longer. So that caused that to strengthen. And so that's why you saw this sudden dynamic and this shift. And we are still in that period now where the pound is weakening against the US dollar. We've got to see when that's going to stop, where the bottom is. If you want to look at the recent low was just under 121, which we had in October. We have obviously been lower than that in recent years, but we could go lower. Don't know that we will do, but at the moment we are still down in that downtrend. If we break below 123, then that does start to open up the trapdoor towards 121 and below. But if we get above maybe 126, then we could be looking back towards that range-bound area we were up to about 127.
So what you're saying really is it's key to look out for when these expected rate cuts might happen. And people who are thinking about holidays in the summer, that's key information for them on how their pound is going to fare against the dollar going abroad.
Yeah, and it's not about trying to play the currency markets, so they're incredibly volatile. But I know what people might be thinking, listening to the podcast. Well, hopefully the pound might get up above 130. Maybe we'll get back to those days where we used to get like 140, 1.5. Well, what this really shows you is the likelihood, based on where we have been, is that 130 was getting above 130. We haven't seen that since last year, and that was a high for that period, and we almost got to 131, and that was a high that would prove difficult to break above in the short term. So it's something to bear in mind, that when you're not likely to see the pound suddenly rocket, and the only way that would likely happen is if the outlook for the central banks change. So let's say inflation proved really sticky in the UK and they thought that Bank of England was going to continue to hike rates, and the opposite was true in the US, then you might see some kind of dynamic like that. But that isn't particularly likely. So the forecasts aren't that's going to happen. So if you listen to nothing else in this podcast, you can tell the kind of range where you're probably likely to see the pound versus the dollar. And I know you might not think that sounds much, some of those numbers I've talked about, the differences, but if you're taking and spending thousands of pounds on holiday, and it does obviously make a considerable difference.
Yeah, so people can take advantage of certain apps like Revolut and look at the prices on that. And like you say, it's not about timing it, but if they're worried about things, then they can use those kind of.
Yeah, and you could, in theory, decide to change up some of your money at different times and just think, oh, if this is the level that we're at.
Almost like pound cost averaging for currency.
Yeah, exactly that. So now do look at the charting tools. They are really good on Yahoo. Most people, it seems to be the best kept secret in finance, to be quite frank with you. No one else I know seems to really use them, but they are great, and they are an easy way to get into and start to see if you can predict trends. It isn't about necessarily trading using that, but if you start to play around with these, start to draw lines, then you might start to realise that there are certain patterns that exist. And like you said, if nothing else, you start to learn some of the dynamics and relationships between different asset classes.
Okay, good stuff. So let's move on to the next piece of the podcast then. We're going to be talking about credit cards. Now, a major provider made a significant change to the minimum payments that you could make on their credit cards. And so we're going to explain what that is and the potential impact of that change.
Yeah, so credit cards, if you have a credit card, as most people will have, and they understand that the fact you have a minimum payment that comes out each month. Now, the minimum payment, and we obviously will caveat this, that you should always try and pay more than the minimum payment, otherwise you'll find it very difficult to ever pay your credit card debt off. What happens is a minimum payment you have to pay each month, and it is set in stone by your credit card provider. Now, they vary, they're not standard across the industry and different credit cards, and you have to pay a set amount or agreed amount each month, and it's usually a percentage in relation to your outstanding balance. And if you don't pay that, then you will have technically defaulted on your payments for that debt, and it will be negative for your credit report. So you'll end up having your credit score when you go to borrow money in the future. It will have a negative impact on that credit scoring.
And it could also include fines and things like that. So you're just going to be causing yourself potential mischief. So always pay the minimum.
So you always set up, this is another tip, always make sure you have the minimum set up on direct debit, just in case even if you clear your balance each month and you manually do that, always make sure you still have a direct debit for the minimum, just in case you happen to forget to do it. You might be on holiday, for example, when the bill is due, so you don't end up missing a payment. Now, to give you an example, Barclaycard, they currently have a minimum payment on most Barclay cards, which is the highest of 3.75% of the balance on the card, 2.5% of the balance plus interest charges, or £5. So you pay the highest amount of that, which means the minimum, the very minimum you're going to be charged is £5 anyway. So it is a percentage ultimately, in most cases, of the outstanding debt. So that is one example. Now, Barclaycard, as I mentioned, they are the ones who are making a change to the minimum payment on their cards. And from July this year, all Barclaycard customers will now pay the highest of 1% of their balance, 1% of their balance plus interest charges, or £5. Now, you might be sitting there thinking, that sounds great, because technically you are now paying less a month for the debt that you've got on your credit card. But that is the problem. And so this, I don't know if this will become a trend within the industry, but it's something that's worth pointing out, because you need to be aware of it, because the impact is quite significant. So let's say that you had a £1,000 balance on your credit card. So you're on this Barclaycard and you are being charged, for example, 24.9% interest. At the moment, if you only paid the minimums, then it would take you 116 months to clear that debt. And the total interest you will have paid is £699. Now, on the new version, so with the lower minimum amount, it's going to take you 231 months, and that will mean you have paid an interest amount in total of £1,665, and that was on, don't forget, a £1,000 initial balance, so the debt was £1,000. Now, that new system means that you're going to take you 110 months longer. That's almost 10 years to clear that debt, and you're going to have paid £966 more in interest. And so that is significant. Really what's happening is that by making these changes, you're going to end up being in debt for longer, and Barclays are going to make more money out of you. So that is something that you don't want to happen. So for people who aren't Barclaycard customers, they might be sitting there thinking, this doesn't matter. But what this does do is highlight a really important fact and a lesson that I've talked about previously on the podcast that probably many people might not have heard. So I just want to reiterate the importance of paying a fixed amount off of your debt. So to give you an example, if you had £1,000 debt on the Barclaycard, so I'm going to use it again just to illustrate. Under the current system where you pay 3.75% plus interest, or £5, it's the higher of those, then you would end up, if your debt was £1,000, you'd be paying this month £37.50. Now, what happens is as your balance starts to slowly go down, so does your minimum payment amount. And so it's almost your amount you're paying off is getting smaller, and it feels like your debt is never going to be almost cleared. It seems to be getting further and further away. Now, if you just stick with the minimums, it will take you 11 years and 8 months to clear that debt, with total interest payments of £884, so it's £884. If instead you said to Barclaycard, I want to keep it at £37.50 a month for good. So you're not increasing the amount you're going to be paying, because don't forget, in the example I've just said, you were going to be paying £37.50 a month, but rather than just letting it be the minimum payment and then that fall in line with the rules of their minimum payments on your debt, as your debt slowly goes down, you say, no, £37.50 every month into the future. Rather than clear the debt in 11 years and 8 months, you will clear it in just 3 years and 2 months, and you will have only paid interest of £397. That is a huge difference. It's one of the best tricks and bits of advice in finance. For people who have debt, I'm not saying to you, you've got to pay more. You might not be able to afford to. Of course, paying more than the minimum is always going to be the best idea. But if you just set it as a fixed amount, even if you can currently only afford the minimum on your credit card, by setting it at that fixed monetary amount for the future, for the duration of the debt, you will clear it at a much faster rate and pay much less interest. So the message of this part of the podcast is, yes, look out for these changes in minimum payments. Do not just pay the minimum if you can obviously afford it. But if you are on one of these credit cards and they do reduce it, then do move your payments back up to the amount in monetary terms that you're okay with. Even if you're not impacted by any changes and you're only paying the minimum, do contact your provider and now pay a fixed amount that's equal to the current minimum in monetary terms that you're paying, because clearly you can afford that. You should be able to afford that going forward, and you'll clear the debt quicker. And hopefully you can do that until such time that you can pay more than the minimum monetary amount. So it's a great tip. It's helped a lot of people, actually, who talked about this on the podcast, various videos. And I did once do a piece on the YouTube channel about a 19-year sandwich, which was actually explain about how theoretically, by only ever paying the minimum, you could actually end up buying a sandwich and it take you almost 20 years to pay it off. So it was just a very powerful illustration of the point that I've just made.
Yeah, and just to follow up on that, an interesting point, if you are someone who uses a credit card to transfer your balances from one card to another, you take advantage of those interest-free offers that you get on certain credit cards. Do look out for what the minimum payment is, because it does differ from card to card. Obviously, Barclaycard have recently changed theirs, but I found myself doing that and moving from a card that had a 1 or 2% minimum payment over to a 5% minimum payment. And while I always paid at least a minimum, often I overpaid on each of the cards. It wasn't much of an issue for me. But if you're budgeting and knowing that you've only got, I don't know, £50 a month to pay off your credit card, and suddenly the minimum payment means that you're now paying 100, I mean, it's great that you're paying off more, but you might not be able to afford it.
Yeah, and you're almost being forced to, because you haven't looked at the T's and C's. I think it's a really good point. I think it just illustrates that something that a lot of people didn't realise, that the minimum payments are actually quite different from different cards. So do bear that in mind. And as a reminder, we do compare credit cards on the Money to the Masses site. Go to the page moneytothemasses.com/podcast, where you can support the show. And one of the things you can do is go on there and you can actually compare different credit cards as well. And we have links on there to how you do that. But there's also a link in the notes of this particular episode where we'll put our roundup of the best credit cards out there, which actually contains information like rates, etc., on these different particular cards.
Okay, so let's move on to the final piece of the podcast then. We're going to be talking about mobile phone providers, and which have come out with some pretty interesting stats and figures based on the best and the worst mobile phone providers. And I thought I'd quickly go through the details on there just to really explain to listeners where we're at in terms of the feedback on customer service and pricing, and where listeners should probably start looking to if they want to look for a mobile phone provider that provides good customer service and good price as well. So the key takeaway from the research that which have provided is that the four major providers, so that is EE, 3, Vodafone and O2, which provide services to around 70% of the UK mobile customer, they fell way short of the standards set by the smaller providers. And they are providers who actually use their networks anyway. They piggyback their service. So the details that which provided, they looked at things like customer service, the ease of getting in touch, incentives, technical support, roaming and the value for money on the roaming services. Damien, I'm sure you've got something to say about that later. Network reliability, download speeds, etc. Now, those four major networks, EE, 3, Vodafone and O2, they all fared pretty poorly, right down the bottom of the league table. And it is the smaller providers which came top of the list. So we're looking at people like giffgaff, Lebara, Smarty and Voxy. Tesco Mobile fared pretty well as well. They didn't get the top marks because they are one of the smaller providers that introduced those mid-contract price rises, which have seen a lot of bad press recently.
So taking what Andy said there, one of the key takeaways is that when we talk about the small providers, a lot of those are piggybacking off the main one. So I'm going to just chuck some out there. For example, Asda Mobile is, I mean, Andy didn't mention them, but they're Vodafone. There's giffgaff, which ride the O2 network. There's Lebara, which is Vodafone again. There's PlusNet, which is EE. There is Tesco, which is O2. So there are a range of these providers that Andy have mentioned that are really just piggybacking the service of, or the networks of those big ones that actually fared poorly in the research. And one of the things I want to pick up on is to do with EU roaming. Now, I have previously benefited from this bit of knowledge that some of these smaller providers that do piggyback, and there's a number of supermarkets that obviously do it, Asda being one of them, they can piggyback and they can actually provide EU roaming, so free EU roaming, even though the wider network that they are piggybacking doesn't, to new customers. So an example here is Asda. So Asda Mobile, you can get free EU roaming with them. Now, there are certain limits, and we're going to put a link to an article in the show notes which talks about all of the best mobile providers, compares them all for data roaming abroad, and particularly in the EU. Now, if you have an Asda mobile phone tariff, then you will get free EU roaming. Like I say, there are certain limits. But if you were with Vodafone, because don't forget Asda is basically piggybacking Vodafone's network, Vodafone don't offer free EU roaming to customers that have joined after August 2021. So that's a big difference. So that is one of the reasons why they've fared well, because a number of them actually do offer free roaming. So the takeaway is, if you are considering some of the big networks, then don't just ignore some of the smaller ones, because they are effectively just, you are taking the big network stuff, but sometimes with a bit of a better deal. And like I say, in the past, I have done that. Some of them have, obviously, they do change over time. I'll give you an example. PlusNet was one such company that had EE, and they did used to give free EU roaming, but now PlusNet have actually started to close their mobile offering. So that is one that's changed. So you just have to check out the article, put a link to it in the show notes, and you'll get more information there.
So moving mobile network is obviously quite a big thing for some people. And of course, you might have reliability issues. You might be in a certain area where you rely on a certain mast, and you know it's particularly good, say O2 is good in the area that you live. So what I'll quickly do is the top 4 networks, I'll read out who the smaller providers are. So it might be worth, if you say, for example, you like EE, I'll give you the ones that piggyback off of EE. So EE, piggyback, so the companies that piggyback off EE are 1P Mobile, BT Mobile, Leica Mobile, and Utility Warehouse. If you're an O2 fan, then look at giffgaff, Sky Mobile, and Tesco Mobile. If you're a Vodafone fan, then look at Asda Mobile, Lebara, Talk Mobile, and Voxy. And then finally, if you're a 3 customer and you'd like to stick with the 3 service, then look at ID Mobile and Smarty.
So that is it for this week, Andy. We covered a range of topics there, from investing, credit cards, and of course to mobile phones. As ever, do support the podcast. Go to moneytothemasses.com/podcast. There is a link in the notes of this show. Do go to our YouTube channel, subscribe. Also, check out the video version of the podcast, but also the audio one. Write comments on there. Communicate with us. I reply to those personally, so you can chat to me, and anything on there that's overtly positive might end up getting a Money to the Masses mug.
Not only do you reply, Dan, you send it around the team and you give us all a bit of a buzz as well.
Yeah, so. I mean, well, I send it around the team, and it does give people a good pick-me-up, because you've got to realise we do this show, and as much as we get feedback from you via emails and things, it is obviously not like seeing people in the flesh. We're doing this, putting it out there like most shows. We have to, anything you write in is greatly received. Don't forget to follow us on our socials, so Instagram. The quiz is on a Monday. Occasionally it does go over to a Tuesday, but we do a quiz after each show, so there'll be a quiz this week on the Instagram feed. You can see a highlight if you miss it, so you can do it any time during the week. There's a highlight there with the latest quiz that's based on this show. Also, in the notes of the episode that we put on the Money to the Masses website, we also put the quiz in there during the week, so do look at that as well. Test yourself, make sure you've been paying attention, and of course do join our Facebook group, facebook.com/groups/Money to the Masses. But most of all, you can find out all of the stuff you can do, cashback deals, how to join a newsletter on that page I said, moneytothemasses.com/podcast.
And that's it, we're done for this week. Until next time.